If you've ever Googled how to start investing, you've probably run into the same two words over and over: index funds, ETFs, and most articles throw them around like they're basically the same thing. Buy either one, don't overthink it, you're good. But here's the catch: they're not actually the same thing, and the small differences between them can quietly shape how much money you end up with 20 years from now. So today, we're settling this once and for all. Index funds versus ETFs. Which one actually wins? In this video, we're breaking down what each one really is, how they're built, how they're priced, the fees involved, and honestly, which one makes more sense depending on where you live and how you invest. By the end, you'll know exactly which one deserves a spot in your portfolio. But first, a quick disclaimer. This is not financial advice. I'm just here to explain how this stuff actually works so you can make your own informed decision. Welcome to Aldric Finance, where we explain investing concepts in a simple way. Let's start with index funds because honestly, this is where most beginners begin their journey too. Imagine you want to invest in the stock market, but you have no idea which company to pick. Apple? Tesla? Maybe just play it safe with Coca-Cola? The problem is, nobody actually knows for sure which single stock is going to perform best. That's the whole reason index funds exist. Think of an index fund like a giant basket. Instead of picking one stock, you're buying a small slice of hundreds of companies at once. An S&P 500 index fund, for example, owns pieces of all 500 of the biggest companies in the US, from Apple and Microsoft all the way down to smaller names most people have never heard of. So when you buy one share of that fund, you're instantly diversified. You don't have to guess which company wins. If the market as a whole goes up, you go up with it. And because index funds aren't run by expensive fund managers trying to beat the market, they're just copying it. The fees tend to be incredibly low. We're talking expense ratios anywhere from 0.02% to 0.20% a year. On a $1,000 investment, that might mean paying just 20 cents to $2 a year. That's basically nothing. Here's something a lot of people don't realize, though. Index funds are only priced once a day. After the market closes, the fund calculates something called its net asset value, or NAV, basically the total value of everything inside the fund divided by the number of shares. So no matter what time you place your order, you get that one end-of-day price. It's simple, it's predictable, but it also means you don't have real-time control over the exact price you're paying. Now let's talk about ETFs, or exchange-traded funds. On the surface, they look almost identical to index funds. An S&P 500 ETF, for example, also holds shares of all 500 of those big US companies. Same diversification, same general idea. But here's where things get interesting. ETFs trade on the stock exchange just like a regular stock. That means you can buy or sell them anytime during market hours, and the price actually moves throughout the day based on supply and demand, just like Apple or Tesla shares would. Compare that to an index fund, which only updates its price once a day, and you can see why ETFs give investors a bit more flexibility and control over exactly when they get in or out. ETFs are also relatively new in the grand scheme of investing history. The very first one in the US, ticker symbol SPY, launched back in 1993, and it's still one of the largest in the world today. Since then, ETFs have exploded in popularity because they combine that broad diversification with the convenience of trading like a stock. Most ETFs are passively managed too, meaning they simply track an index like the S&P 500 or the NASDAQ. But there's a twist. Some ETFs are actively managed, where a professional handpicks the investments trying to beat the market. That's something worth checking before you buy, because it changes the entire risk and fee picture. So if they're both diversified baskets of stocks, what actually separates them? Let's break it down step by step. First, pricing and flexibility. Index funds settle once a day at their closing NAV. ETFs trade in real time all day long. If you're a long-term investor who's not checking prices every hour, this difference barely matters. But if you value control over your entry and exit points, ETFs have the edge. Second, fees. Both can be extremely cheap. A lot of ETFs charge as little as 0.03% a year, and plenty of index funds land in that same range. So don't assume one category is automatically cheaper than the other. You actually have to check the specific fund's fact sheet. Third, taxes. This is where it gets a little more complicated, and honestly, it depends heavily on the country you live in. In the US, selling one fund to move into another is generally a taxable event, whether it's an index fund or an ETF. But in some other countries, certain fund structures allow you to switch investments without triggering an immediate tax bill, letting your money grow tax-deferred until you actually cash out. So this one really comes down to your local tax rules, not a universal rule you can apply everywhere. Fourth, accessibility. Many ETFs can be bought commission-free on most brokerage platforms today, and the same goes for a lot of index funds. So again, this playing field has mostly leveled out over the past decade. Here's something worth thinking about from a broader research perspective. Studies comparing actively managed funds to passive index-style investing, whether through a mutual fund, an index fund, or an ETF, consistently show the same pattern. According to data compiled by Morningstar, only a small minority of actively managed funds actually beat their passive benchmark over long stretches of time, often somewhere around 3 out of 10. That statistic isn't about index funds versus ETFs specifically. It's about passive versus active. But it tells you something important. The vehicle matters less than the philosophy behind it. Whether you choose an index fund or an ETF, staying passive and low-cost tends to outperform trying to pick winners. Let me introduce you to two fictional investors, Emma and Daniel. Both decide to invest $10,000 into the S&P 500. Emma buys into a traditional index fund through her retirement account. She sets up automatic monthly contributions and never checks the price during the day. She doesn't even really think about it. Daniel, on the other hand, buys an S&P 500 ETF through his brokerage app. He likes being able to watch the price move and occasionally buys a bit more when he sees a dip during trading hours. 10 years later, assuming they both picked funds tracking the same index with similarly low fees, their returns end up almost identical. The real difference wasn't in the returns. It was in the experience. Emma found investing boring and hands-off, which honestly worked well for her personality. Daniel enjoyed the process more, felt more engaged, and that engagement kept him consistent instead of drifting away from investing altogether. Neither one is wrong. The best choice ended up being the one that matched how each of them actually behaves as an investor. So let's be balanced about this, because neither option is universally better. Index funds are great if you want total simplicity. Set it, forget it, no temptation to check prices constantly and make emotional decisions. The downside is less control over timing, and depending on where you invest, potentially fewer options for very specific or niche exposure. ETFs are great if you want flexibility, real-time pricing, and the ability to react during market hours. The downside is that flexibility can become a trap. The same feature that lets you time your entry can also tempt you into overtrading, checking your portfolio too often, and making impulsive decisions based on short-term price swings. And here's an important myth to clear up before we wrap up. Just because something is an ETF doesn't automatically make it better than an index fund. Yes, ETFs trade like stocks, but that flexibility isn't always useful, especially if you're investing for the next 20 or 30 years and have no intention of trading daily. So, which one actually wins? Honestly, for most long-term investors, the difference between a low-cost index fund and a low-cost ETF tracking the same index is small enough that it almost doesn't matter. What matters far more is staying invested, keeping your fees low, and picking whichever format keeps you consistent. If you know you're the type of person who'll obsessively check stock prices and panic sell during a dip, an index fund's once-a-day pricing might actually protect you from yourself. If you value flexibility and you're disciplined enough not to let that flexibility turn into impulsive trading, an ETF works just as well. The real winner isn't the fund type. It's the investor who stays consistent, keeps costs low, and doesn't let short-term noise change their long-term plan. If you found this helpful, hit the like button and consider subscribing. It really helps this channel keep growing. Let me know in the comments, are you Team Index Fund or Team ETF? And if you enjoyed this one, I think you'll like the next video just as much. Thanks for watching, and I'll see you very soon. Bye.